would be July 9th would be the date. That was the date she requested. Could we move it from June 1st to July 9th? And I agreed to do that. And that she said we will rapidly get together and see if we can work something out.
Hello and welcome to the week ahead on Nomura Podcasts. I'm your host Andrew Tysess from our Global Markets Research team, and today's Friday the 30th of May. Well, we've had a few surprises this week. You heard a rather noisy snippet there from President Trump, who was speaking from a tarmac, and after speaking with European Commission President Ursula von der Leyen, Trump agreed to roll back a 50% tariff hike on Europe to 9 July to allow more time for talks. Later in the week, we learned that most of Trump's tariff hikes had been blocked by a US court. Now, Trump said he'd appeal, and we think the administration will eventually be able to implement those tariffs. But equally, all of this is highlighting the unpredictable, unconventional nature of policymaking there, and that net has been weighing on the US dollar and US assets too. And I think this could yield unintended consequences. Trump would like more investment in the US, but he could end up with less if heightened uncertainty causes businesses to sit on their hands there and global investors to shy away. And he'd like other countries to come to him offering trade deals, but it seems that some of those could involve other countries cutting deals with one another and isolating the US. So this week I'll be checking in with some of my global research colleagues from around the world, George Buckley in London, Ruchir Sharma in New York, and Sonal Varma in Singapore. We're going to touch on some of these issues and give you our take on the key macro and market developments to look out for next week. There's a lot going on, so let's dive in.
With the right policy responses, there could also be opportunities. The changing landscape could open the door for the euro to play a greater international role.
So let's kick things off in Europe this week, and I'm delighted to have George Buckley, our chief Euro area and UK economist, here with me. Hi, George.
Hi, Andrew.
Excellent, thank you. George, I played a little clip there from ECB President Lagarde, who seemed to be making the case for the euro as a strong alternate reserve currency. That surprised me, and I wanted to ask, what's going on here? Is Lagarde giving the idea of European integration a bit of a push? You know, things like a banking union or joint debt issuance? Or is she taking a bit of a swipe at the US?
So the joint debt issuance issue, I think, is quite politically charged. So I suspect she's not talking about that particularly, but I do think she would like to see increased integration in Europe. I mean, there are a few things that need still to be done to push forward that integration story. Banking union, she would love to see, and the ECB would love to see further pushes towards that. I don't think it's trying to push the euro in one direction or another. That's not the task of the central bank. They obviously have to account for movements in the euro, but you know, we have seen also depreciation over the last few months in the euro since the start of the year, and I'm sure this story will have a lot further to run. It would obviously help in terms of financial stability as well if you have more support for the euro going forward. I think it's something which the ECB would generally like to see.
Okay, got it. That is interesting. Hey, I'm sticking with the ECB. Let's move back to more conventional territory for Lagarde. We have a policy meeting next week. What are you expecting?
We're expecting, as is the markets, a 25 basis point rate cut down to 2%. We think there's further to go as well. So we've got another 50 basis points thereafter, taking us down to 1.5% terminal by September. Now, that's a lot faster than what the markets are expecting. Markets have a 1.75% terminal, and that's not reached until next year. As I say, we've got 150, and we think it's going to be much sooner. But a lot to focus on because we've got the new forecast from the ECB. I suspect what they're going to do is to incorporate some of the actual data that we've got within their forecast, and what that will mean is that we see core inflation revised up and headline inflation revised down. And that downward revision to headline inflation, not surprisingly, is due to things like, as mentioned before, the euro appreciation, but also weaker energy prices. So lots to think about, but 25 basis point rate cut from the ECB.
Okay, so 25 next week and then 2 more 25s to 150 terminal. And George, finally, just on the data calendar, it does look like a busy week ahead. So I'm just going to give you open slather here. Is there anything in particular you'd like to highlight?
I mean, it is a busy week with lots out, but I'm not sure any of it is going to be too market moving. A few things that I would highlight. There is actually a lot of big official data due in Europe next week. And what I mean by that is that your industrial production, your retail sales, unemployment, that sort of thing. Unemployment likely to stay very low, still below what we think is equilibrium. Industrial production obviously has been very weak, especially in Germany over the last few years. So we'll be watching out for that. And retail sales, Germany's actually done pretty well on retail sales recently, as has the UK. So worth watching those numbers. But so yeah, lots of things out. I'm not sure any of it is going to be majorly moving. And I think the ECB decision and what they say and their forecast is probably going to be the most important thing.
Okay, George, excellent as always. Thanks so much.
Super. Thanks very much, Andrew.
Now, let's move across to North America. I'm joined here by Ruchir Sharma from our New York-based research team. Ruchir, we've had a lot of toing and froing on US tariffs this week. What are your latest thoughts?
Hey, Andrew, it's great to be back. And definitely among the toing and froing, there's one thing that's certain, that there's going to be a lot of uncertainty. So after last week, when we saw Trump actually put out thoughts about 50% tariffs on EU, and they were eventually pushed back to July. But what happened this week was, again, a much of a roller coaster. So we saw on 28th May that a US court struck down most tariffs that President Trump had imposed. But just a while ago, as we are speaking, an appeals court granted a stay on the ruling and has ruled that tariffs may temporarily stay in effect. So again, there's a lot of volatility there. So the ruling on 28th May, that impacts IEEPA tariffs or the reciprocal or the fentanyl tariffs that Trump levied. But the steel and aluminum tariffs, those are still in place. But let me say, this is far from over, and the administration has plenty of other arrows in its quiver, and they could opt to implement tariffs under alternative authorities. So again, there are two ways. One is via courts, that they appeal, similar to what happened, and they get a stay. And the other one is to use other statutory authorities. For example, they could use Section 122 to put up broad tariffs up to 15% for about 150 days to address trade deficits. They could also use Section 301 tariffs to initiate investigations, and they could use Section 338 to impose country-specific tariffs. And then you also have your sector-specific tariffs under Section 232. So there's a lot of things that they can do. But long story short, it's far from over, and the administration can definitely eventually implement tariffs. And I think broader strokes are that there's going to be a lot of uncertainty in the medium term about these things.
Okay, good one. My goodness, there's certainly a lot going on there and things are changing fast. So thank you for bringing us the latest on that. Now, if we just turn our attention to the data calendar, there's a lot going on in the US next week, but it's payrolls week too, and that's probably the highlight. What do you think that May jobs report will show?
Yeah, so all eyes are definitely on job gains next week, and we expect that actually job gains slowed sharply, and our forecast for private job gains is that it moderated in May to about 110K. And the unemployment rate actually remains sideways at 4.2% for the month, and even there's a risk that it rounds lower to 4.1%. But in the medium term, the gradual increase in the unemployment rate is likely to resume. As for the government job gains, it continued to slow because of the hiring freeze that's still in place. So big picture is what hard data from jobless claims and from soft data, that's like the business surveys and even anecdotal evidences, and even Fed's been talking about, is that it's the firms are on a wait and see mode. They're waiting for tariffs to settle. So this has led to a slowdown in hiring. So we haven't seen broad-based evidence of layoffs yet, but it's just that businesses have postponed hiring rather than outright cancelling it.
Okay, got it. And finally, Ruchir, while I've got you, I thought this week we'd cross that little line that Mr. Trump has referred to and have a look at Canada. Canada's major trading partner is the US, of course, and things are so uncertain there. And we've got a Bank of Canada policy meeting to look at next week too. What could we hear there? Definitely
another important event next week is the Bank of Canada meeting. So things aren't actually looking super rosy for the neighbor in the north here, and as growth outlook remains pessimistic. And we've seen that both consumer and business sentiment has plummeted in Canada due to the trade war. So spending and capex plans, they remain subdued. And additionally, labor market in Canada is particularly weak. Slack persists. The unemployment rate actually climbed in April, and private sectors shed jobs for 2 consecutive months. So on one hand, you have headwinds to growth from tariffs, since Canada is closely intertwined with the US. And on the other hand, you have inflationary concerns from tariffs, which is again, convoluting the Bank of Canada's task here. So definitely the April CPI was hotter than expected, but there were a few one-offs, there were some blips. But if you look closely at the report, there were positive signs. The disinflation trend is continuing. So taking all of this into account, we think that inflationary concerns, definitely they're important, but they're not imminent, while downside risks to growth are. And given that recession risks in Canada remain elevated, we think that it's more likely than not that the Bank of Canada delivers a 25 basis point cut at its June meeting next week. That's our call.
So a rate cut from the neighbour in the north. I like it, Ruchir. Thanks so much.
Thanks a lot.
Now, moving to Asia, I'm lucky to be able to chat today with Sonal Varma, Nomura's chief economist for India and Asia ex-Japan. Sonal, I know it's been a very busy week for you. Thank you for making the time.
Thanks, Andrew.
Okay, let's start with India. The Reserve Bank there is meeting on Friday next week. What are they going to say about the economy, and will they announce a rate cut?
Yeah, 25 basis point cut is actually widely expected. So market focus is more on the RBI's forward guidance in terms of the depth of the easing cycle. So we think there will be some forecast changes. So on the inflation front, we are expecting a downward revision to around 3.5% for this financial year from 4%. So actually below the RBI's midpoint target of 4%. The growth forecast should be unchanged at 6.5%, but we do think RBI is going to flag that growth remains below potential. And I think the guidance should be dovish in terms of a commitment to ensure adequate liquidity, and also reiterating that monetary policy needs to be accommodative for transmission to happen. So I would say, including the cut we're expecting next week, for the full year, we are expecting 100 basis point in total cuts, which is actually more than consensus of 50 basis point more.
Okay, good one. So a rate cut, dovish guidance, and 100 bips all up. Got it. Hey, let's talk Asia, big picture. A number of countries are going to be releasing inflation data for May next week. We can't cover them all, but I wanted to ask, is there any sort of broad theme here? What's the inflation outlook for Asia this year?
Yeah, so for next week, I think inflation should broadly be benign and soft in the region. There are 2 outliers to flag. One is South Korea, where we are expecting the headline to actually pick up by 0.1 percentage points to 2.2%, mainly reflecting sticky services. And the other outlier on the other side, in fact, is Thailand, where we are expecting a deeper deflation. So inflation going to minus 0.9% from minus 0.2 on food and energy. For the year, Andrew, I mean, our outlook is it's going to be a period of below target inflation. And I think there are multiple disinflationary drivers that are at play. So you have a negative output gap, wage growth, which is slowing, oil prices are fairly benign, the rainfall prospects look favorable, and you have China's overcapacity. So we do think Thailand and China face deflationary risk, and we are expecting below target inflation in India and Philippines this year.
Okay, got it. Good one. And finally, Sonal, I know you're helping to run Nomura's investment forum in Singapore next week with hundreds of attendees. So I wanted to ask, can you give our listeners a little sneak preview? Are there any key thoughts on Asia that you'll be taking to that conference?
So our flagship Nomura Investment Forum Asia runs in Singapore next week from 3rd to 5th of June. So we'll have presentations from global thought leaders and, of course, Nomura's senior research team on the economics as well as on the markets side. I mean, for us here in Asia, we will be exploring tariffs and their impact, whether China's growth can sustain, the pace of BOJ's policy normalization, role of fiscal versus monetary policy, and, of course, the latest on supply chain shifts. I mean, things are uncertain, but we think there are ample investment opportunities in Asia. So we will deep dive into our high conviction out of consensus call. So it's going to be an exciting week ahead. And for all Nomura clients who are listening, please do reach out to your sales rep. And we look forward to seeing you all at NIFA.
Fantastic. Sonal, thanks so much and good luck next week.
Thanks a lot, Andrew.
We're going to finish this week with 2 quick highlights from across the broad Asia region. First up, Japan. Do keep an eye out for April earnings data and a speech by Bank of Japan Governor Ueda. We think total cash earnings in per capita terms will pick up in April, though the underlying trends there seem more mixed. And that speech by Ueda next Tuesday should be interesting too. I'm curious about whether we'll receive any more clues about the policy outlook in Japan and what he might have to say about the wild volatility we've been witnessing in long-end JGB yields. And last but not least, my neck of the woods, Australia, Q1 GDP data will be released, and we have that showing modest, below potential growth of 0.3% quarter on quarter and 1.4% year over year. Consumer spending and business investment in Australia look to have been pretty flat in Q1. Okay, so there you have it, short and sweet. Our views on major market themes and what to look out for next week. Written by Andrew Ticehurst and the Global Markets Research Team, expertly edited and produced as always by John Dalton. Thank you for listening to our podcast. If you did enjoy listening to the show or want to hear more from Nomura's economists, researchers or investors, please like and subscribe to Nomura's podcast on Apple, Spotify and SoundCloud or wherever you do get your fill of podcasts. If you have a moment, please leave us a review. And as we always say, it would make our day if you could press a few buttons and share this podcast with a colleague or a friend. For more, log on to nomuraconnects.com to keep up to date and to keep on listening. Thanks, goodbye for now, and see you next week.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.